Have you ever run a comparable company analysis? If you have, then you know how empowering it can be to invest in a stock when you know that compared to all of its closest peers, it is significantly undervalued. In this video, I'm going to walk you through, just briefly, the 4-step process for conducting a proper comparable company analysis. Welcome back. If you're already a subscriber, let me tell you, it's good to be back. Feels good. If you're new here, hey, my name is Steven Spicer and it's my goal to help you invest smarter. Now, over the last several months, I've been creating a lot of content and resources for the stock selection course that I'll be launching over the next 2-week window. And I have sincerely missed interacting with you. And it recently occurred to me that I have all this course content over here that I could easily just share some of it with you. So that's what I'm going to do today. And if you find it helpful and would like to see more clips, please take a second, let me know in the comments, and I can absolutely get you more. So far, the most raving feedback that I've received from the beta students going through the course regards my step-by-step walkthrough of the analysis process. And the big standout from that is my breakdown of my go-to analysis methodology, the comparable company analysis. So I want to share the overview of that process, of that analysis methodology with you today. Without further ado, let's cut over to Steven inside the Empowered Stock Selector course. Steven? Now, this first analysis is one that I run almost every time. I can't think of a time that I don't, or that I haven't. It's pretty essential. In order to value your company, you really should have something to compare it to. I mean, that's true for anything that you're trying to value or measure. And you can't just compare it to the market as a whole. You can't even necessarily just compare it to its industry. Ideally, you find companies that are very similar. Of course, they need to be in the same sector and probably should be in the same industry, and they need to be offering the same or very similar product or service. But your analysis is going to be even better if you can find companies serving a similar demographic, utilizing a similar distribution channel, located in a similar or the same region, with a similar market cap, and so on. You get the idea. Obviously, there will be differences, but the closer, the better. The more accurate your results, the more confidence you can have in the results of your analysis. And if you can't find any comparable companies out there, you may not want to invest. Yes, a company without good comps does create additional confusion, which breeds opportunity, a quality we generally gravitate toward. But unless you have a unique knowledge and insight about this particular company or its industry, you're going to be operating entirely in the dark, which is never safe. It's never a good idea. So that's the first part of a comparable company analysis. Find comparable peers. I'll show you how I do that in just a second. The second part of this analysis is determining which valuation multiple you should use to compare these companies. I'll usually use EV over EBITDA for capital-intensive industries and EV over EBIT for most others. And I explain the rationale behind those metrics in a short video series that I'll link out to below. But sometimes EV over sales or price to book value or something else makes more sense. And I'll walk you through determining that as well. Then we'll need to validate the key fundamental metrics that we'll be comparing. What I mean by that is we need to make sure that we're comparing apples to apples here. A lot of new investors miss this. For example, we need to take out any one-time or non-recurring expenses and or income that might be reflected in these numbers. It's not always there, but if it is, it can skew our results and then they won't be reliable. Finally, and maybe we're doing this as we validate the numbers, we need to pull all the relevant information onto our worksheet. And then the worksheet will calculate for us the most important figures. And at that point, we'll be able to answer the question, is the potential upside enough? Does it meet your standards? Most won't. Great, get them out of here. Who's next? It's that easy. And if they do meet your standards, that's exciting. Let's see if there's another valuation methodology we can use as well, and then we'll move on to assess the floor. So I hope that conveys the general idea of what we're doing here. Go ahead and pull up your workbook, check out the additional resource text below this video. Let's get behind the computer and work through one of these together. So there you have it. The 4 essential steps when conducting a proper comparable company analysis. Find comparable peers, the closer the better. Determine a relevant valuation multiple. Validate the key fundamental metrics that you'll be using in your analysis. And then find the averages and see how they compare to your company in question. When you take the time to do this right and discover some significant upside potential, you'll feel so much more confident when you go to invest. It can be rather empowering. So whether you're interested in the course or not, I hope this helps you on your journey to investing smarter. If you are interested, check out investlikespeiser.com to see what's happening. As I record this, we have a launch coming up, but the cart for that will close mid-December. And I honestly do not know when we'll be launching again. Whether I'm able to continue to help you here or to provide you with more enhanced experience inside the course, either way, I'm looking forward to it. I wish you all the best. Take care.